Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lafoy. Let's get right into what happened in the markets today. All right, we saw canola up $12.70 at the close to $735.90. It was higher during the session. We'll show a chart on that in a bit. Minneapolis wheat down 12 cents to 622 and a quarter. Crop condition ratings likely had something to do with that. Kansas down 4 3/4 to 536. Chicago wheat down 7 1/4 to 536 and a half. We got to soybeans unchanged on the day at 1069 3/4. Soybean oil was up limit in the front month on the December, which is the one that we're kind of tracking on this chart here. It got up to 55.45. That was up 4 1/4. Limit today was expanded from 30 cents or 3 cents per pound to 4.5 cents a pound because of Friday's limit up move. Corn was down pretty big as well, down 9 3/4 to 434 3/4. The Canadian dollar did trade up towards 73.85, but settled, or at least at the time that this was snapshotted, at 73.76. That's the highest we've seen in some time. Cattle, we got live cattle up 192 to 215.55. We got feeder cattle up 380 to 310.22. All right, let's get into the U.S. crop condition ratings. We saw a pretty big increase, or sorry, a pretty big or a pretty good crop condition rating from the USDA today. 72% good to excellent. That is right at the top of the 5-year range. And kind of in line with where we were last year at this time exactly. We did start to see it come off a little bit, but last year we also kind of saw a deteriorating crop condition rating as we moved through the early part of the year. This year we're kind of seeing the opposite. We've been seeing gains week over week. So 72% this week, 71% last week. Again, that's right on par with last year's and the 5-year high as well. As we move into soybeans, we did see some reductions in soybeans, actually. 66% good to excellent this week versus 68 last week. We are kind of tracking about the average in the middle of the 5-year min-max. So, nothing really too concerning here, but a reduction nonetheless. So, tomorrow we may see a little bit of support on this crop condition rating change. Moving into winter wheat, winter wheat crop condition ratings are becoming relatively benign, but I did want to point out a couple of things here on the harvested side. We do have harvest starting in Kansas now at 11%. I would say that's probably the most important one at this point. We do have, Texas at 57%, Oklahoma at 46%, North Carolina 30. Those are all relatively, 56, 30, and 38. Oklahoma's a little bit behind schedule, but not by a whole lot. They can get caught up pretty quick. Texas is pretty much at schedule. North Carolina is pretty much at schedule. So is some of these other states like Arkansas and California. They're not the biggest wheat growing states. As you can see, we start to get Kansas above average at 3%. So they're below average. They're starting now at 3%, where the average is about 11%. All right, spring wheat crop condition ratings, though, rose 4 percentage points. Obviously, the market was expecting some of this based on the declines that we saw specifically in spring wheat futures today. I don't know if they were expecting that much, though. So a 4 percentage point gain is a pretty big one. That brings spring wheat crop condition ratings back up to average and right in the middle of the 5-year min-max as well. So, crop condition ratings are improving in the spring wheat growing areas. I don't know if this report was fully priced into futures, so we may see a little bit more risk on the spring wheat side tomorrow as we move into the trading session tomorrow. All right, let's get to the good stuff here. July soybean oil went limit up today, closed at 55.11. So Friday's limit was 3 cents a pound. Today's limit was 4.5 cents a pound. We actually saw a gap in the open this morning, and this closed limit up as well, 4.5 cents up. Again, 55.11. There's a little bit more liquidity, obviously, in this market than there was on Friday. Here's December soybean oil. It did not close limit up. 55.45 is where this one ended up on the day. Not quite at the highs of the day, not quite at limit, but still a very, very attractive day for soybean oil. Just to kind of recap, in case you didn't see our information on Friday, the big move for this vegetable oil complex has been from the EPA's proposed blending mandate. They have increased. There was an expectation that they were actually going to cut the proposed blending mandate, but they increased it. So for 2026, the proposal is 24 billion gallons. The proposal for 2027 is 24 and a half. But that's only half the story, because really it's the biomass-based diesel portion of the blending mandate that is really making a difference in the vegetable oil market. There we see the proposed mandate jump from 3.35 in 2025 to 5.61 billion gallons in 2026 and 5.86 in 2027. So the market is reacting heavily to that. If you'd like a more detailed version of what this mandate means, and particularly what it means for Western Canadian farmers, you want to subscribe to our premium content. It is $99 a month. This was the cover page of our report that went out on Friday. We send out reports every Friday. We send out ad hoc reports as things come out as well, such as USDA or major market movers. So if you just go to CanadianAgMarkets.com/subscribe, you click on the subscribe button right here. It'll pop up this little window. You put in your details and you will be off to the races. All right, getting into some of the oil seeds here in Canada. November canola had a very good day today as well, closing 735.90. The November, as we've kind of been mentioning, has had a shift recently in the open interest and the volume as we kind of chug through this month of June, and the delivery month of July comes closer. So November is kind of trading as the de facto front month now, which can also be witnessed by looking at the July NOV spread. We've seen a big reduction there in the July NOV spread. Now, this spread, I'm going to show to you a different way. Hopefully you can see this with the blue candlestick charts here, or sorry, the blue open, high, low, close chart here. But we did see this spread actually sink to $1.40 intraday. So it closed at $7.20 between the 2 months, but we did see it trade as low as $1.40. So if there's a potential that this actually could go from an inverse into a positive spread between the July NOV, meaning that the NOV trades at a higher value than the July. What that means for farmers is that if you're looking to roll a contract from the July to the NOV, if it is a contango or if there is a carry in the market, that's going to cost you money as opposed to you receiving some money back. So of course, the easiest roll is done at zero when the markets are relatively flush or equal. It did kind of move towards that today, as I mentioned, but backed off a little bit. So if rolling a contract, and I'm not saying this is a suggestion or anything, but if rolling a contract is in your plans, you may want to pay attention to this spread before it goes into a contango, because then you'll be paying to move to the new crop month instead of getting paid to move into the new crop month. So just a little bit of tidbit of information there in case you are looking to roll a contract. Now I'm going to move into corn here. It's not something I normally do, but we did see corn make a new low today. New lows are always concerning, just like new highs are always exciting. Again, it tried to trade above the 20-day moving average today, failed in doing that, and then punched to a new low. As you can see, the Thursdays, this is the agriculture and drought report that was released on Thursday. So there's been a couple of trading days to digest this, but I think that it kind of tells the story of what's happening. We saw a 1% bump up in crop condition ratings, but the crop is still very young. I think what you look at here, though, is last week, 21% of the crop, the corn crop, was in some kind of drought, whether mild or more moderate. to more severe. This week, that has dropped 3 points to 18%. So the risk of drought is dropping, and I think that's having an impact on just on the perception of the corn market at this point in time. Here's a map that shows the areas that are in drought. Now, I know Nebraska is heavily in drought. There's a lot of drought in Nebraska, and Nebraska is an important state for corn. I mean, after all, they did name their major sports teams, university sports teams, after the commodity of corn, and we recognize that Nebraskan corn is important. But in the grand scheme of things, it still is. There's still a lot more areas that have good crop condition ratings or reducing drought risks as we move through this growing season so far. Just to kind of illustrate what that looks like from a graph standpoint, Nebraska, yes, 80% of it is under drought stress. Nebraska, as you can tell here, is responsible for about 10% of the country's corn production. The other big states, of course, being Iowa, Illinois, Minnesota, Indiana. Nebraska is important, as I said, but not the most important. And the I states tend to be the ones that kind of trade the markets, and those are in relatively good shape. Looking at it from another perspective, this is kind of a historical chart of where the drought has been moving. And as you can see, over the last 3 weeks, we've seen that decline from 23% to 21 and now to 18, and we continue to see the more severe or more intense drought declining a point or two as well in that same time frame. So the risks are moving out of the corn market, long story short, and that's why we are seeing some weakness in the corn market. Now, soybeans is a bit of a different story. We saw modest gains in the soybean market today as a result of even though soybean oil rallied to limit pricing today. Soybeans are a little bit more muted. It hasn't broken this high from mid-May as of yet, just south of 1070. Again, some of it is weather, right? So soybeans again saw 16% in drought last week, 13% this week. If you look at the map, lots of areas of soybean country are void of any drought risks at this point in time. Again, Nebraska is the one that's really sticking out at this point in time. They only grow 6% of the corn, and the more intense drought is also, further west in Nebraska. That's not to say that the Nebraska is not, Nebraska still has a lot of risk, but by and large, the soybean crop looks pretty good. I did want to show one quick chart here, which is soybean board crush margins. Now, this is the September soybean board crush margin. As you can see in the last couple of days, it has absolutely skyrocketed from 168 bucks a ton to 196. So this is just astounding change in the soybean crush margin as we've seen the soybean oil advance. Now, in theory, this is a really good thing, right? And we have seen gains in the soybean market. We want there to be more demand for soybean, and the more demand for soybean crushing there is, the more demand for soybeans proper there is. But there is a kind of a negative trade-off, which I think is having a bit of an impact on soybeans as well, and why we're not seeing soybeans rocket higher like we are with soybean oil. And that, of course, is that soybeans are also made up of meal. And in fact, soybeans are made up of more meal than they are oil. Compared to canola, which has like 42% oil, soybeans have about 18 to 20, 22%, depending on the variety and depending on the year and all that kind of stuff. I use kind of 18 as my benchmark. So that just means that 80 to 82% of the soybean crush is still going into meal. And so what that means is that if the market is deciding, hey, we want to crush soybeans for oil, the oil is what's valuable in it. We're going to crush as much as we can in order to get the oil out. That means that they're pushing soybean meal onto the market. And that is why we are seeing such a huge decline in soybean meal, and why the soybean futures market proper isn't rallying quite as much as we would like it to. I mean, it is rallying, no doubt about it, but soybean meal is kind of keeping it down a little bit, keeping it a little bit humble. Now, putting more soybean oil or soybean meal on the market isn't necessarily what we want to do, right? The USDA is projected 475,000 short tons. This chart that I'm showing you is displayed in metric tons, which the rest of the world uses. But for all intents and purposes, they are expecting an increase in soybean meal, and that was before this announcement was made. So again, there is more soybean meal getting built into the S&D now, which is putting a lot of pressure on meal, which is adding some pressure to the soybean market as well. Now we want to take a look at soybean oil used for biofuel. Now the last USDA report again was released prior to this EPA announcement, so this could change in the next month or two as we get the new USDA data released. Just to kind of show you though where we were at before this EPA announcement, the USDA was anticipating that 13 million pounds, 13.9 million pounds of soybean oil were going to be used for biofuel this year. That was 47.3% of all of the soybean oil production. So that, it was already forecasting a record amount of soybean oil to be used for biofuel, not necessarily a record amount by percent. We saw close to 50% a couple of years ago, but I think that we may be seeing some adjustments from the USDA as we move into the next few months because of this EPA data that was, or EPA announcement that was issued this week. All right, I think that that about wraps it up. That's about all we have for you today. We don't want to make this too long-winded. We'll continue to add some detail in tomorrow's video. So overall, thank you for tuning in. We hope that you tune in again tomorrow. Have a great day. We'll see you again tomorrow.